Thank you so much for joining us here. Obviously, you're covering some of these big names that are reporting here today. Citi, I want to start with talking about sort of still waiting for the investment banking business to turn around. We know the deal environment has not been as robust as we've seen in the past. What will it take to change that, to turn that around as Citi shares move lower here?
Thank you, Courtney, for having me on. And I would say what's going to turn it around is the Fed getting to its terminal rate on Fed funds. If the Fed reaches that terminal rate come, let's say, September, and the outlook for the Fed funds rate is, flat for 6 to 9 months and maybe a rate cut in the second half of next year, that would be very positive for the markets, particularly in the investment banking space. We also need to see that the companies that may need to go public or want to go public, they have to recognize valuations today are far lower than what they were back in 2021 at the height of those valuations. So once those companies recognize that, the valuations are down and we get a steadiness from the Fed, that could set the investment banking business up quite nicely for the latter part of this year and into 24.
If we look at the rest of these businesses, and obviously the banks have so many different silos here, that's sort of the investment banking, more commercial side of the business. But what are today's reports telling you about the consumer in relation to spending, credit availability?
It's interesting, the consumer spending numbers, if you look at the JP Morgan data, we're good. The credit availability for consumer, whether it's credit card receivables or auto loans, still very strong. Consumers, of course, have access to this credit. The only area that we really saw today, and it was with Wells and also with JP Morgan, but JP Morgan has a very small portfolio here. It's the office commercial real estate. That's the area that is starting to show real deterioration. Wells pointed that out. JP Morgan, again, has a very small portfolio, but they also identified that. But on the consumer side, to your point, the consumer is very resilient, similar to what Mark Mason was saying earlier in the program.
So, Gerard, let's talk about the ways still left to play this. JPM and Wells, I think, are above your price targets, but you still feel good about them, particularly JPM. Meanwhile, regionals, some of those you cover, they start reporting next week far below your price targets, but they're expected to have news that's not quite as positive, right? So what's an investor to do?
Yeah, it's a really good question, John, because when you take a look at it, the margins today for both JP Morgan, Wells, and Citi, net interest margins, came in better than expected. Now, granted, they were down slightly. In the case of Citi, they were actually up. And that has been the big headwind for the regional banks, because we all expect to see them use higher cost funding this quarter due to the problems we saw in the first quarter with the failures of Signature and Silicon Valley Bank, and then, of course, the First Republic failure in May. And so I think what we're going to see is that the numbers aren't going to be as bad. And so we will see margin compression, but we could be surprised to the upside that it's not as bad as expected. So for the regional names, to your point, the stocks are cheap. And I think this credit picture, if it follows through, that most of these regionals do not have big office commercial real estate portfolios, their credit pictures should also be good, and that will give them some resiliency going into next week's numbers.